Everybody, it's Chris Buteau. Welcome to another edition of the Mortgage Mastery Theater. And we're going to address the question of rolling closing costs into your loan today. The question comes up often, can I roll my closing costs into my loan? And that makes sense, because borrowers want to know how much cash they need to have all in. And the closing costs have to come from somewhere. It's really dangerous to conflate your down payment with your total funds needed to close. And that can be a really rude awakening for all parties involved. If it's a purchase transaction, of course, for the borrower, for the sellers, for the realtors. If the borrower doesn't realize until deep into the process that he needs to cover his down payment and closing costs. Sometimes borrowers will come to me and they'll tell me, I'm going to put 50% down. And I want to be sure I'm clarifying with them. Let's say it's a $100,000 purchase. Does that mean you have $50,000 all in for the deal? That's all the cash you have available? Or do you have $50,000 plus closing costs? And do you know what those are? And then, of course, that leads to the question, can I roll those closing costs in? And on the one hand, the essence of rolling closing costs into your loan is quite simple. It's simply increasing your loan amount to lower the amount of cash you need to put into the deal. And it's the semantics and loan program differences, primarily between conventional loans and government loans, that obscures this simplicity. And I want to illustrate that a little bit. I'm going to show you a table here. And here's a table where I've started out with just a simple illustration of the same purchase transaction with two different options of either rolling or not rolling, quote, the closing cost into the loan. And you see here, option one, in this column, we have a purchase price of $100 and we have $5,000 of closing costs. So the total cash that has to come from somewhere is $105,000. Now let's say in your mind you're putting 50% down, so that's a $50,000 down payment, so you're going to borrow $50,000, right? In this case it just happens to be 50-50, probably not a great choice, it'll be confusing. But the total cash you need to close is $55,000, and that's the $50,000 down payment plus your closing cost of $5,000. So the borrower has to come up with $55,000. And so did we roll the closing costs into that loan? And the answer, most of us would say is, given those assumptions, no. And let's go then to option two. And let's say the borrower says, I'm going to roll those closing costs into my loan because I don't want to bring $55,000. And so same deal, same $100,000 purchase, same $5,000 closing cost. But in this case, now instead of borrowing $50,000, we're going to borrow $55,000. So our loan to value is now 50% is 55%. And the down payment, instead of being $50,000, is $45,000. And the down payment percentage is 45% instead of 50%. Remember, the down payment percentage is just the inverse of the loan to value. If 100% is our standard, we're trying to get to 100%. If we have a 55% loan to value, then our down payment percentage is 45%. But in this example, the total cash needed to close is $50,000. And so the question is, did we roll the closing cost into that loan? And the answer is yes and no. We see the difference here is, did we roll the closing costs, or did we just simply increase the loan amount to lower the cash that we needed to close? And the program differences is where this confusion comes in. And we'll look at a table in just a second to illustrate these differences. But the questions that we're really answering when we're trying to answer the question is can I roll my closing costs into the loan, is really, can I increase the loan amount to cover some or all of the closing costs? Does the program allow it? Do my circumstances allow it? Can I increase the loan amount? And what are the implications of doing that? And then should I do that? And I want to show you another table that will illustrate this with several different examples. And it really illustrates kind of the program differences and why the term rolling the closing cost even exists at all. Why do we use that term instead of simply saying, can I increase my loan amount, to lower the amount of cash I need to close? And we see this in column one. I'm going to show you an FHA, in this case, it's actually an FHA loan example. And the reason I start with the FHA is the reason that term rolling closing costs in exists at all is because of government loan programs. And there is a technicality in which you could say they're actually allowing you to roll the closing, or at least some of the closing costs, into the loan. On conventional, so government programs are like FHA, VA, USDA, they all have funding fees, or most of those have funding fees. And those costs can be rolled into the loan amount. We'll illustrate that here in just a minute. Whereas in conventional lending, typically you're not allowed to roll the closing cost in. But let's just take a look at this example and illustrate this further. So in FHA, for example, you have a purchase price of $100. Now FHA is a 3.5% down program, so you're going to borrow $96,500, and your loan to value is 96.5. But FHA has this funding fee. It's a 1.75 points. It's a one-time fee. It goes to the FHA, and it can add quite a bit to your loan. Now in this example, where $1,750 probably doesn't seem like a ton, but I'm using a $100,000 loan amount or purchase price. $100,000 doesn't buy you anything almost anywhere, right? So really that fee can be quite substantial. But FHA allows you to roll that cost in. It doesn't allow you to roll the other cost in. So it's not a blanket allowance to roll all the other costs in. For example, your appraisal, title, escrow, etc. Those costs can't be rolled in. But it does allow you to roll that funding fee in, that $1,750. And so your adjusted loan amount here is $98,250. And this table, and what I'm showing you here, is what's the actual loan to value? What is the actual loan amount divided by the value of the property? Well, the actual loan to value now, instead of 96.5, is 98,250. You're putting less than 3.5% down. But FHA allows you to roll that closing cost in, and the way that they work that out is they essentially deem the loan to value there to be still 96.5%. They basically say, we're still going to treat that as if you put 3.5% down. So we're going to allow you, even though the FHA program, in theory, requires you to put 3.5% down, you're putting less down here because you're borrowing $98,250 on a $100,000 purchase. But we're going to deem that to be 96.5% because our program allows you to roll certain closing costs, just that funding fee, into the loan. So this is allowed. And there's no loan structure changes, right? Nothing changes. And the question is, did we roll the closing cost in? In this case, clearly, yes. We rolled the closing cost in within the meaning of that term. That means we added that, we increased the loan amount, but we didn't change the structure of the loan. We didn't violate the maximum loan to value percentages, etc., in relation to that. Now let's compare that to conventional, and this is where the confusion comes in sometimes. Because on the one hand, you're not allowed to roll closing costs into your loan on a conventional. But most borrowers, when they're asking that question, they're not really worried about the technicalities. They're just wondering, can I increase my loan amount so that I can borrow, so that I don't have to bring as much cash in? And so the answer is that depends. It depends on the specific loan program that you're in, how much down payment you're putting down, and whether you qualify. Maybe you've borrowed as much as you possibly can, and you can't borrow $1,000 more, and because that'll throw your debt-to-income ratios out of whack, and you won't qualify anymore. So maybe you can't for that reason, or maybe the loan program doesn't allow it. So let me show you an example here. Let's show you one where it's clearly not allowed to increase your loan amount in a conventional situation or to roll your closing cost in. Let's take that same purchase of $100,000 and let's say you're borrowing $97,000. The maximum you can borrow in most conventional programs is 97%. Okay, there's no funding fee on a conventional loan. Let's say you have closing cost of other closing cost of $2,000 that you want to roll in. And so if you did that, now your loan amount is $99,000 instead of $99,000. And the actual loan to value is 99%. And here's where the rub is. Conventional doesn't deem it any different. The conventional doesn't allow you to roll a closing cost, so your actual loan to value and your deemed loan to value are the same. And so now when you've tried to roll those closing costs in, you've increased that loan, your loan to value is 99%, the program doesn't allow it. You can't borrow 99% on a conventional loan. So this is just not allowed, and there's no loan structure changes here because it's just not allowed. You didn't roll your closing cost in. But let's look at a situation where maybe you are allowed to roll your closing cost in, and essentially to increase your loan amount, but maybe it's not prudent to do so. Same exact purchase, $100,000, but now let's say we're going to put 5% down. You come in with the mindset, I'm putting 5% down, I'm borrowing $95,000, and there's no funding fee. This is conventional again. And let's say you want to roll $2,000 of closing costs. Now your loan amount goes from 95, you're putting 5% down to 97. So your actual loan to value is 97%, not 95. Your deemed loan to value is 97%, not 95. Now, is this allowed? Well, yes. Conventional lending, Fannie and Freddie have a 3% down program. So you're allowed to do so. But it requires loan structure changes because you're no longer in the program that says you can put 5% down. You have to go to the 3% down program. Do you qualify? Sometimes there's income limitations to those programs. The pricing is different. The mortgage insurance is different. And so in this case, someone asked me, can I roll my closing cost in? Well, the answer is yes. I mean, technically you can, but is it prudent to do so? Probably not, because it's going to require a lot of program changes that are going to unfavorably increase the cost of money. And so if you can find the funds, now on the one hand, if you don't have the money and it's the only way you can get in the house, maybe that's the thing to do. But probably not prudent to do if you have another way of coming up with those extra closing costs. And let's just look at finally an example where it's allowed to do unconventional and it's prudent. It's okay to do so. Same exact situation here. You purchase price of $100,000, but now you're putting 40% down. So you're borrowing $60,000. You're putting 40% down, and now you come and say, "Wow, $40,000. That's all I have, all in. I really don't have any more. So I'd like to roll some closing cost in. Let's say it's $2,000 closing cost. So we want to adjust our loan amount to $62,000. Now in this case, the actual loan to value is 62%. The deemed loan to value is 62%. Well, is this allowed? Yes. And does it require any loan structure changes? No. You're putting either 40% down or 38% down. The pricing's probably going to be the same. There's no mortgage insurance involved, right? Because you're putting way more than 20% down in both of those situations. So there's no real loan structure changes. So in this case, you can say, yes, you can roll your closing cost in. But another way of saying that is, can I lower my down payment? Can I, instead of put 40% down, can I just put 38% down? And in that way, it's just a semantical way, difference of thinking about what you're doing here. But in each case, the essence of that question is, can I increase my loan amount so that I can lower my cost to, my cash needed at closing? And the answer is, it depends. It depends on the program.
So a couple questions. So it kind of sounds like it would be better in general if like 95% of the time when people use the term rolling closing costs, they just didn't use the term at all. Is that what you're saying? It would be better to kind of get rid of that term most of the time?
Yeah, I think that the term definitely obscures the essence of what is a very simple question. Can I increase my loan amount? And the problem comes in, when you say, can I roll my closing costs in, that brings in to the conversation all the additional implications of, is it a conventional loan? Is it a government loan? Are we speaking of technically, can you do that? And then if I'm allowed to do that, what are the implications of that? And so I think that, the onus is on the professional, the mortgage professional, to explain, what the essence of that is and what the implications of that is, and then to advise the client, with regard to whether they should do that or not. But yeah, I think really, if we could just talk about, can I increase my loan amount to lower my cash to close? Is that okay? And what are the implications of doing that? I think things would be a lot simpler.
So what all is included, say for when you can roll your closing costs, an FHA loan, what are those closing costs that are included that you can roll?
Yeah, very, very simple question, very easy question, because there's just one fee that you can do, okay. And that's the FHA funding fee. It's 1.75% of the loan amount. And it gets rolled in, so you're not bringing that extra cash to close. So on top of the 96.5% of the purchase price that you're borrowing, they add that fee on that, so you're borrowing that too, and you're not bringing that as extra cash to close. Same with VA. VA has a funding fee as well. VA funding fee is scaled depending on whether it's your first use or subsequent use and how much down payment you're putting. But the VA has a funding fee, and it's the same sort of thing. You can roll that in. And of course with VA you can borrow 100%. But it's 100% of the purchase price plus that funding fee. That doesn't cover any other costs, title, escrow, etc.
For a conventional loan, when people ask if they can roll their closing costs, and it's a scenario where you can increase your loan amount, you're going to do that for them.
Yeah.
Because they don't want to have to pay more cash up front than
right.
what they planned on. Say you were going to pay a $40,000 down payment, and then you didn't realize, or you didn't want to pay more on top of that. So you wanted to have a larger loan amount.
Right.
So you're still paying that $40,000, and you are actually paying your closing costs up front. Is that correct? But instead of $40,000 of that being down payment, $5,000 of it is closing, or.
Yeah, and that really kind of highlights the essential semantical difference.
Yeah.
Because on the one hand, if you have this $100,000 purchase, and you come into the mindset of, I'm putting 40% down, Okay, that's 40,000. You know, that means you're putting $40,000. You're borrowing 60.
Mm-hmm.
But then if you realize during the transaction, wait a minute, that means I have to bring 45,000 out of pocket.
Mm-hmm.
And I wasn't thinking about that. I was thinking down payment meant all the cash I needed. Now I'm realizing, no, I need down payment and closing costs. And so really it's just a semantical difference. But you're saying, no, I'm actually not. In reality, you're not putting 40,000. You know, if you're borrowing now instead 65,000. Okay, you're putting 35% down because down payment is a mathematical calculation, right? It's how much cash down divided by the purchase price of the house. That's your down payment percentage. So in that example, you'd say, no, I really only want to borrow 35. I mean, I only want to put $35,000 down, and then I'll pay the closing costs on top of that. So that's 40,000. Doesn't really matter ultimately if you call that, oh, I rolled in those closing costs, or I put less down.
Mm-hmm.
The essence is the same. You just increased your loan amount and you brought less cash to the table. Whether you paid them sort of, you know, out of pocket in your mind, or whether you rolled them into your closing cost in your mind doesn't change anything.
At what point is it reasonable to change what you're putting down? If you get qualified for a certain amount or something, and then what does that process in reality look like sometimes? At what point in the buying process are your clients where you've made that change for them?
A lot of times that you want to do a good job up front of educating your clients about the transaction and going through detailed calculations. Usually you get a pretty good idea of a price range, even if it's a big price range. You can say, okay, let's look at the low end, let's look at the high end, and let's look at all the implications of that. How much cash you need to bring, what those components are that are contributing to that cash you need to bring, down payment, your closing costs, what your monthly payments are going to be at different points. So hopefully they're pretty well educated. Mm-hmm. But even being really well educated and familiar with everything, that doesn't eliminate the fact that once you get to the real deal, and now you've got a real interest rate, a real purchase price, real estate taxes, everything is coming into much greater focus. And at that point, the buyer may say, maybe they'll start the loan and say, I'm not sure if I want to put 25% down or 30% down. And so in that scenario, if I really felt like my clients really were uncertain, as to which way to go, I'd probably start with what is the more challenging from an underwriting standpoint. So let's start with the higher loan amount, because that's going to be harder to qualify for. Make sure you qualify for that. And then if you have to change down the road, that's fine. Now, the closer you get to the closing date, the more challenging it is to make those changes. Mm-hmm. Because you can make those changes, but then it has to go back through underwriting, go back through the process, and that could delay closing. And so you want to do that relatively early in the process, but you should have plenty of time to kind of have a real clear idea of, okay, now I know kind of really within plus or minus a few $100s how much cash I have to put into the deal. That helps you answer that question with greater clarity rather than in the abstract when you're just shopping and you've got this big price range.
Yeah.
Thanks so much. Hey, if you like this, subscribe, like the video. My contact information is in the notes there below. If you have a question about a specific loan, I'm licensed in Washington and Idaho, but I can answer questions all over most of the stuff is pretty universal across the nation. So if you have questions, feel free to reach out, send me an email, send me a text, and be happy to help you out. Thanks so much.